Can you imagine being the investor that has over $80 billion invested in the market? And of course, on that note, we're talking about Warren Buffett. When it comes to inspiration, when it comes to investing principles, he is probably the absolute best strategist. The Oracle of Omaha, sage advice from buying stocks, buying index funds, managing cash flow, and of course, Berkshire Hathaway's CEO. However, when it comes to investing like Buffett, how can you do this on a lower level or even with a smaller amount of money? That's exactly what we're going to be looking at in today's video. 6 ways to invest tiny sums of money according to Warren Buffett, starting with number 1, investing early. When you start looking at the importance of investing early, this really harnesses that power of compounding interest. It is super significant. The earlier that you start putting money away, regardless of if it's $10, $20, $50, whatever it is, the more time you're giving your money to grow. When you think of it like a snowball going down the hill, at the very beginning, it's going to be tiny. As it continues down a very long hill, as it continues getting larger and larger, and the balances continue to get higher as contributions go up and contributions stay consistent, the snowball will get to the point that it is just a mammoth size of investment portfolio that is going down the hill. Now, no matter your risk tolerance, when you look at millionaires and when you look at self-made millionaires, majority of them, over 90%, are from investing in the market. So of course, when you look at diversification, we always talk about ETFs. Specifically, I talk about the S&P 500. Index fund investing is the way, honestly, even looking at Warren Buffett, he says index fund investing, everybody should be in the S&P 500 index. And I really do believe that, and I invest in it myself through a multitude of ways. Now, second one we look at is diving into the stock market and looking for discounts. Now, he is notorious for discount shopping, looking for good deals, looking for recommendations, looking for businesses that are at a discount. Now, this does take a lot of time and effort. Now, personally, for me, looking at the market and looking for companies that have strong fundamentals, good growth potential, I do not invest in individual stocks. I do not, and I have not really in probably almost 30 years do I invest into any single stocks. But when you start looking at Buffett's advice, the biggest one is investments over time on the value of the company, not really what social media is telling you, not really what is focusing around the news where they are, but looking and breaking down the nuts and bolts of what those companies do bring. Now, third one, he talks about focusing on smaller companies. Before investing in some of those top stocks like Bank of America, Coca-Cola, he mentioned the best period that an investor is starting with a small sum of money is taking a little more risk, looking at some of the smaller companies that you can pick up with a higher growth potential. Now, it's kind of interesting because looking through this article, a lot of people are saying, a lot of financial advisors, a lot of forecasters are saying that a small growth company, so outside the S&P 500, but looking at your small cap companies are willing to do the work. There's no question that you have an opportunity to get very large returns again with small cap companies because they are a lot smaller. And of course, if you're looking at something like an ETF, there is ETFs and there are ETFs out there that focus on small cap companies in the US market. So it could be another strategy really breaking it down. Now, the fourth one, don't worry about the short-term fluctuation. This is one of the biggest ones. When you think of your index funds, when you think of investing in general, what happens is people will put money into the market. Let's say they put $100 in there. All of a sudden next week, it's at $94. They sell it immediately. They take that $6 loss. They're out of the market. They don't want to do it. They felt and really emotionally tied to where their investment is. This is where you have to really zoom out and looking at 5 years. When we talk about investment strategies, when we even talking about doing this with tiny sums of money, it is about looking at a 5-year picture. When you start, again, zooming out even further, looking at the S&P performance over the last 10 years, it goes much higher. When we even start zooming out further than that, looking at the average return of over 10% for the S&P 500, again, you can look at the long-term growth potential, not the 30 days, not the 6 months, not the 1 year, but we are talking 5 years plus, not worrying about that short-term fluctuation. And also, it takes a lot of practice. It takes a lot of dedication. Like I had to learning about the stock market and understanding exactly what you're investing in, but also using it as mathematic equations versus emotional investing. Investing in companies that you like because you hear it on the news, you hear it on social media. I advise you to do your own research, know exactly what you're investing in. If you want to invest again in ETFs, if you're thinking cryptocurrency, REITs, if you're going into real estate, Whatever it is, you have to know exactly what you're investing in, and it's going to be investing over a consistent amount of time to really see that growth. Now, the fifth one he talks about, be prepared for hard work. This, of course, is something when you're investing with small sums of money, just like when he started out, requires effort, requires research of the companies. He warns investors never take it easy or should never be really easy. Looking for great investment opportunities do require a little bit of work, knowing exactly what you're getting into. And I also say this, there's a lot of people that chase easy money. When you think of things like get rich quick, you give me $5,000, I'll give you $50,000 back. It's very easy to chase the money, but it doesn't make logical sense. Majority of the time, when you start looking at, a trading bot, you want it easy, you want a trading bot, you want it to do all the work itself. It usually doesn't work like that. And even if some people do have success, there's always a greater number of people that lose an incredible amount of money. They talk about, oh, I made $100,000 trading cryptocurrency. That is not the normal, guys. A lot of people go in, they invest in something they don't understand. They see it fluctuate down. All of a sudden they sell out, and that's it. They're done in their entirety. And the final one he talks about is diversification, but not too much. Now, while diversification is very important to mitigate risk, he believes on focusing on a few great opportunities. Diversification is a protection against ignorance. Pretty interesting statement when you think of ETFs because they offer instant diversification. Makes very little sense for those who know exactly what they're doing in the market. For me, like I said, generally, I don't want to spend the time and effort researching individual companies, getting into, a 2,000-page document that is provided from companies to break down everything you need to do in there. So it's not too easy. And when we think about diversification as well, in relationship to 401k plans, you look at target date funds, very well diversified, but is invested in a bunch of different things. ETFs, again, majority of individuals, we're talking about Gen Z, talking about millennials, north of 80% of those segments invest in ETFs and they love ETFs. Now, of course, the older brother, the more expensive brother, mutual funds are managed by an individual. So if you want to pay for a financial advisor, it is going to come with a little bit higher of a price tag. But overall, if you start investing, and of course, do not put all of your eggs into one basket or all your funds into one basket. The way that I advise to do it is if you're new to investing, if you have a small sum of money, is get into the market, whether it's getting into Robinhood, whether it's M1 Finance. We have some links down below to get involved, but putting $50 in there, putting $100 in there, just staying with a very small amount, learning exactly what you're investing in, exactly what it means to be invested, watch the market, see the trends, do your research, knowing exactly what you're doing. Like I said, for me personally, I do a ton of research when it comes to exchange traded funds or ETFs, but I do not do individual research when it comes to the companies within those ETFs itself, because thinking of something like that S&P 500, you have 504 companies within an ETF. I am not going to do the research on 500 plus companies. For me, the time is not there. The diversification is there when I'm investing in that ETF, and it does make a big difference with the time and effort that we do put in there. Again, I like the investing side a little bit more simplified. I don't want the complexity of individual stocks, which is the reason why I do not invest in those. But all right, guys, so that is going to do it for today's video. 6 ways to invest tiny sums of money according to Warren Buffett. Let me know in the comments what you guys think, and I'll catch you in the next video.